Hello everyone, it is day 2 in the book review series and I am your host Miss KK on the Wave, your weekly show that dissects topics related to personal, family and business finances. And really all we are hoping is that by the time we get to the end of the series, you'll be better equipped to make sound financial decisions. If you're new here and you haven't really checked out our video from yesterday, we are discussing this book, which is The Money, a user guide by Whatley, and this is our second episode. Yesterday we did look at money and love, and today we are going to be looking at understanding debt. But before we get into that, if you are new here, please consider clicking the subscription button so that you can join this awesome community where we discuss various money topics. And if you're already a subscriber, thank you so much for always making time to pass by and listen to what we have on the show, right? So this book, as I mentioned, has a lot of topics, and today we are going to be looking at paying off your debt, but not necessarily really in paying off your debt, but understanding debt, right? So I like this book because it's a detailed guide, and it tries to break out a lot of topics into more details to help you understand the right terminology, help you understand the nitty-gritties of each topic, and the author really did take time to understand different type of debts. And if you don't understand how different types of debts work, you might end up in a situation like we've discussed in another video where you are using an incorrect bank account for incorrect savings. You might be actually using the incorrect debt for incorrect financing needs. And if you really understand the characteristics of various debts, the reasons for various debts, the pros and cons for various debts, you are likely to be making a sound decision on that. So there are a whole bunch of different loans in the books, but I'm just going to touch on the ones that I think are critical and that are most common, especially with amongst the young professionals, so that you understand. And we are starting off with personal loans. So really, personal loans are normally that type of money that you take when you may be needing to take money to finance a wedding. For a lot of people, they get through their wedding process by taking personal loans. Normally, if you want a new car, but generally when your car is not being financed, so you know that a lot of car financing is a secured form of lending, such that if you default on the car loan, they will come for the car. Whereas with a personal loan, you take money out, not necessarily to finance the car, but you use that money to buy a car. So this is the financing option that is normally used by people that are buying cars in the second-hand market that are not being sold by bank-approved car dealers. Or maybe you don't have a license and you really want to buy a car, so you take out a personal loan, then you go and use that money to buy a second-hand car from your friend, for example. And sometimes, people take personal loan to fund things like holidays, etc. So what you need to understand is personal loans tend to be a lot expensive than your secured lending, because this is almost it's normally a form of unsecured lending. The bank has no collateral. There's no collateral attached to the loan. So take for example, you take a home loan. You take a personal loan to go find a holiday. Then if you default from paying that loan, the bank cannot come and remove the experience from you, because you've already gone on that trip and you've already spent the money. As opposed to secured lending, like we've mentioned with the car, if you default, the bank will come for the car. So that's the difference between secured lending and unsecured lending. And unsecured lending, because the bank is exposed more to risk, it tends to be a lot more expensive than your secured lending. Normally, a personal loan would involve you paying fixed monthly installments, and it's normally on a short period of time. It can range from 12 months to maybe 36 months. And what you need to watch out for this personal loan is you need to make sure that you are reading the fine print of your contract and watching out what are the fees if you early settle your loan, or if you miss a payment. Remember that we said, like with things like home loan, there is a penalty-free period, i.e. you are free to pay your loan off after maybe, let's say, 5 years with the bank, and the bank is not going to charge you any interest. It's the same thing with personal loans. There's generally a period to say you are taking a personal loan, you're committing to pay for 24 months, but you cannot settle it off before maybe the 13th month, for example. Speaking hypothetical example here, if you do so, you're going to be penalized heavily. So you need to watch out for early termination fees if you do intend to early settle your loan, or you need to watch out for bounce payments. And remember, we also had a different video. You must just check out the cost of bounce payment. If your payment does bounce, you get charged a fee up to $200 in Namibia per bounce debit order, right? So really, that's personal loan. And then the other loan that the author gets to look at is the payday loans. We did actually also speak about soft loans, and normally soft loans do fall into payday loans, but here normally it's you going to the bank or you going to a cash loan to actually get a payday loan. And a payday loan is really that bridging finance that you need between the day you take out the loan and when you're expecting your next monthly installment. And they also tend to be a lot expensive because it's easy, quick money, and it's agent money. Plus normally payday loans are fully repayable when you are expecting your money. So let's say you take 6,000 because you want to fix a few things between 15th and the 20th. So by the 20th, the bank is expecting you, or that cash loan is expecting you to pay back the full 6,000. It's normally not paid in installments because it's a bridging loan. You are saying, yes, if I had the money, I would have paid this 6,000, but because I don't have the money, when I do get the money, I'll still be able to pay 6,000. So that's the aim of payday loans. And unfortunately, for a lot of people, they misuse payday loans, especially if it comes from friends. They want to now negotiate a payment installment, but when they actually took the money out, they were promising they will pay you in full when they get paid. So that's the type of payday loans. You must avoid payday loans because if you do default, number one, they're expensive. Number two, they can hurt your credit score. When we will discuss in a later video of what the banks look at when you are looking out for a home loan. And number three is the author discusses credit cards, and I actually didn't know how credit cards work up until that point, and I was really fascinated at learning the difference between an overdraft, for example, and a credit card, etc. And I'm just going to highlight some of the basic features in an event that you don't know how a credit card works, so that you can actually make a wise decision if the bank were to offer you a credit card or not. I don't know if you did watch one of my videos, I don't remember the title, I'll put it up here, where I said my banker called me and said I qualify for credit card, but because I have, the name of the video is Learning to Say No Financially, so you must just check it out. My banker called me to say I qualified for a credit card because I've been banking with them for X number of years, and I'm a good client, so I qualify for a credit card. But I didn't know how to say no. But essentially, the reason why I was a bit hesitant to say no is because I didn't even know how credit cards works. So I tried to beat around the bush until I got myself out of it. But here is how the credit card works. So when you are choosing a credit card, there's a different range of credit cards that have different features. When you are choosing a credit card, you need to choose the one that is responding to your needs, and that's the one that will save best. You cannot be taking a credit card that benefits you from getting points from air mileage, for example, if you don't fly at all. But if you are a business person that flies every second week, you might want to take that credit card because essentially in the long run, you might be able to get discounts on your flights, etc. So the basics of a credit card is you get a spending limit to say you can spend this much without the bank bothering you. So for example, they'll give you a credit card and they'll say your spending limit is 20,000. So that means 20,000 per month, for example, or 20,000. So that means you can spend up until 20,000 without the bank bothering you. And that is well within your limit, and you are unlikely to incur excess fees for as long as you are within the payment period. And normally, they will give you an interest-free period where you can repay back that balance. So let's say I have a credit card of 20,000 per month, and not per month. If I have a credit card of 20,000 and I've spent 9,000 on that for the month, for example, so I have 1 month to clear that 9,000 off interest-free. Majority of the time, the interest-free period is 1 month. So, but I'm not obliged to pay the 9,000 in that month. I can also service what is called the minimum payment. So the bank will calculate for this 9,000 that you've spent, you need to be paying at least 3,000 per month for us to be comfortable and for us to retain, for you to retain your good standing on this credit card. So the bank actually prefers that you don't pay the 9,000 off in full. You pay the 3,000 per month, then they can at least collect some interest income from you. So ideally, you need to make sure that if you are going to be utilizing this credit card, are you going to be able to clear the account off during the interest-free period? Because because if you are able to clear it during the interest free period, it's actually cheap financing. But for a lot of people, they are unfortunately not able to clear it within the interest free period, and they opt for the option of servicing their monthly installment, and that way they get charged in interest. But the interest on an overdraft is probably still, on a credit card is probably still going to be cheaper than your payday loan, for example. So if you do have that option and you have to evaluate, must I take a payday loan or must I spend on my credit card, you might want to actually opt to go for your credit card. And the other thing with the credit card, right, you can swipe on your credit card, but you can also get cash from your credit card. You can decide to withdraw the money. But if you withdraw the money with a lot of banks, you actually get charged automatically interest from the day one of you withdrawing your money. So remember I said, if you normally have an interest free period, which is 1 month. So if I go to Pick n Pay and I decide I'm going to buy my grocery, let's say I'm short of bread, bologna and juice in the middle of the month, and I'm really dry and have a credit card, then I decide I'm going to use the credit card to swipe at Pick n Pay to buy my groceries that will take me to month end. So for that groceries that I buy there, right, it will be interest free for the month. But if I decide, you know what, I really need the cash, I need 300, and I go and withdraw that money, 300, they will start charging me 300 from the day that I withdraw the money. So obviously, if you have a credit card, refrain from withdrawing the money, because that way you actually get to make use of the interest-free period. Whereas if you are withdrawing the money, you actually getting charged from the day of withdrawal. Why the banks do that, I'm not really sure. Okay, and ultimately with a credit card, you need to make sure that you are able to refrain from spending. Just because you have 20,000 as your credit limit, it doesn't mean you must use the 20,000. You need to use it when you need it. And for a lot of the banks, actually, when they see that you are a good client, you always honor your minimum payment, you don't really max out on your credit card, and you are sort of exhibiting good habits, they can actually automatically lift your limit. So let's say you were the bank sees that you're now earning 30,000, previously you were earning 20,000, so they can actually automatically lift your limit from the 20,000 that you have to 50,000, for example. So you need to watch out also, if you are the person that can already not control their spending and likes doing this impulsive buying decision, you don't want to have a high credit card limit, because that cannot do anything than put you more into debt, and you might struggle to clear that to clear that off within your interest-free period. And if you don't clear that off, you might actually be spending more in interest on a monthly basis, right? So that is now the use of credit cards, right? And some credit cards also now, like I've mentioned, has options of cashback and airlines miles that you get. But what I want you guys to understand is that we must not get into the habit of spending things just to get points. You'd find, the person is going all their way out to go and spend, 200, and if that 200 is giving you 1 point, and 1 point is equivalent to $1, did you really just spend 200 unprovoked to get 1 point? And is that 1 point still really worth it? And some of these points actually have a catch to it. They might tell you, your points expire after 8 months, for example, and you need 800 points to actually qualify to buy, let's say, 1 ticket. So you need to evaluate whether the points are worth you spending. And if you are not able to redeem the points within a relatively short period of time, then ultimately the benefit that you're getting from the points is actually being cancelled by the interest that you're getting charged. If you are spending and you're unable to clear your balance within the interest-free period, that's what you need to understand about that. And also, lastly, what I want us to discuss, what the author discusses here, is the overdraft. Overdraft sort of works like a credit card. You also have an approved limit, but sometimes there's an authorized limit and there can be an unauthorized limit. So for example, an authorized limit is where you go to the bank and say, you know what, maybe I'm a small business owner, I sell most of my goods on credit, so my customers take a bit of time to pay me, but I need to pay my suppliers cash. So for me to be able to pay my suppliers cash, I will struggle because I'm still waiting for my customers to pay me. Can the bank please allow me an overdraft of 50,000 so that I can be able to still honor my commitment to my suppliers while I wait for my customers? That is the typical arrangement. You go in the bank, then you sign for it, and they say your authorized limit is 20,000. So that tend to be charged at a reasonable fee. But then you also have situations where a bank can allow your account to go into a minus even if you don't have an approved limit, and that minus is normally small money. So let's say your salary is supposed to come in and there's a glitch in the system and your debit order bounces, or we all know that our accounts have fixed monthly fees, and by the time the bank wants to take their monthly fees, there's nothing in your account. So at that time, you're going in and actually an unauthorized overdraft, because by the time the bank came to fetch their money, there was nothing. So they still took, and then your account went to the minus. When you receive money, they first take the negative, clear some small interest on that, and then you are good to go. So authorized overdraft can get quite expensive if you start speaking about large amount of money. But for things like bank charges, you may not actually feel it, because the extra interest sort of just become parts of the bank charges, really. Yeah. So why is the author writing about this different debts and how you can get out of it? Today I'm just highlighting the different type of debt so that you understand what sort of debt is available. So when people talk about overdraft, what do they mean? When people talk about credit card, how do they work? Do you actually need a credit card? When people talk about personal loans and payday loans, what do they actually mean? And if you are to find yourself in a situation where you need to take a loan, do you understand the differences between the different types of loans, and are you actually in a position to make an informed decisions? Then there's a whole bunch of loans like your car financing, your mortgage, and etc. So those ones work slightly different from what we actually spoke about here, but those ones are a lot more common. But if you want me to speak more into mortgage loans and car financing loans, how they work, you are free to leave a comment and I'll do a video on that. Really, that was all we had from today's discussion. I hope you learned a thing or two. Please consider sharing the videos with your friends so that they are also informed about the different types of loans available. And if you haven't done so, please consider clicking the subscription button so that you can be notified every time I upload a new video. And as usual, stay safe and sanitize. Bye bye.